We're here today with Bill Longbrake, Executive in Residence at the Center for Financial Policy. Bill publishes a monthly letter for us called the Longbrake Letter, where he touches upon various economic topics. And today he will be chatting with me about some of the issues that he brought up in his latest April letter. Thank you for joining me today, Bill.
It's good to be here with you, Michelle.
To start things off, I wanted to talk about the employment report that just came out this morning. And this report showed that 244,000 jobs were created just last month. Now, Dow Jones previously reported an expectation of 185,000 jobs to be created. Based on the risk that you laid out in your April letter, was this unexpected? And what does this mean in terms of recovery for our economy?
Well, Michelle, I think if you look at all the employment data, and there's a lot of it, some of it's very positive and some of it's sort of lukewarm and some of it's kind of ugly. All right, so what I said in the April letter was that we would have a slow recovery, and I think the employment reports that have come out in the last few days are very consistent with that finding. Let me review some of the statistics here, just for the sake of people who are watching. Unemployment claims came out, and they spiked enormously, and it surprised the markets. It was wildly above expectations, and the stock market initially reacted quite negatively. The Bureau of Labor Statistics, which puts out that report every Thursday morning, explained that this week's report was actually probably not very reliable because of a late Easter, the fact that Oregon put in place a new unemployment program, and they even mentioned supply chain interruptions because of the problems in Japan.
Right.
All right. So pretty much the market very quickly then discounted the importance of that number. But that's illustrative of when data comes out. Single point data oftentimes has got things that are oddities in them that smooth out over time as you get revisions or additional reports. So let's take a closer look at the payroll employment report. There are actually two reports that come out at the same time. One is called the payroll employment report. The other one is the household survey. And they're actually done in two different ways. The payroll report is based on a survey of employers, payrolls. I mean, I guess that's sort of obvious. And the household report's actually done on a survey of 60,000 households. So it's collected in a very different way. And from a month to month, the reports can be quite different, but over a long period of time, they converge. And this particular month happened to show quite a divergence, which probably will get ironed out in the future. But let's review the numbers here for a moment. As you said, the payroll reported 244,000 net new jobs were created in the month of April on a payroll basis. And there are actually backward revisions to February and March of 45,000. So actually, it wasn't just 244, well, closer to 300,000 upward revision totally. So that's very good. But if you look then at the household survey, guess what happened? It said that 190,000 jobs disappeared in the month of April.
Well, that's interesting.
Yes, it's very interesting. So you've got one going way up and the other one down. Now, if you look over a longer period of time, there's also a divergence that requires a little explaining. Payroll employment over the last year has been up 1.4 million, or about 1% increase year over year. But household employment's only been up 0.2% during that period of time, or about 300,000 jobs. And if you look at another measure that's in the household report, it's called the labor force. And what the labor force is the number of people who want to work or are working. And the difference between the labor force and the house employment number is the unemployment number. That's how that's derived. Well, the labor force over the last year has declined 0.7%, or 1.1 million people. So what's going on here? Well, I won't force you to answer that. I'll give you the
Is
answer.
that the discouraged worker effect?
It's the discouraged worker effect.
Okay.
It's people who can't find jobs, who simply are dropping out of the labor force. They're not looking for work anymore.
Right.
But when they don't look for work, they're not counted as unemployed. And so part of the decline in the unemployment rate up until this month was due to the discouraged worker effect. Now, this particular month, you had the labor force go down and the unemployment number go up. And the unemployment rate went from 8.8% to 9%. So you cut through all of that, and kind of the bottom line is 2 steps forward, so jobs are being created, but 1 step back, that the people are being discouraged and the labor market's still quite weak overall. Another indicator of the weakness is if the labor market is strong, then people have ability to compete for higher wages, to push wages up.
Sure.
Well, the wages year over year right now, the hourly wage rate's up 1.9%, and if you adjust that for inflation, it's actually purchasing power is down slightly over the last year. And that's been very stable for several months now. It's actually, that's a good thing that it's stable, but it's not a good thing that it's not rising.
Right.
And overall, it indicates that the labor market still is incredibly weak, but slowly improving.
Slowly. Now, with the discouraged worker effect, when the economy does recover some more and these workers now become encouraged as they re-enter the labor force, does that mean that the unemployment rate will still remain fairly steady because they are now re-entering the labor force and they are going to be counted as unemployed?
You're thinking in the right direction. It probably will continue to come down as the economy strengthens, but not as rapidly as the number of new jobs created might suggest.
Understood. Great, thank you. Moving on, Ben Bernanke, as you know, held a news conference following the FOMC meeting. No surprises really came out of that. He stated that QE2 would conclude as planned in June, and that he really gave no indication of monetary policy tightening, no specific indication, that is. As CNN pointed out, though, and as other word counters pointed out, he mentioned the word inflation 31 times during his prepared remarks. When do you think that the Fed will tighten the monetary policy? What factors are going to lead to a situation where Bernanke will think about tightening this monetary policy?
Well, Michelle, let's first of all just remind everybody that the Fed has 2 mandates. One is full employment and the other is price stability. And so it's not just one, it's not just keeping inflation down, it really is getting unemployment down as well.
Right.
Now, all the talk, as you pointed out, 31 times inflation mentioned, and it was mentioned even more in the question and answer session, and it was noted by those who do the word counts that unemployment came up very little. But, this is the important point, is don't pay attention necessarily to all the yakking. Pay attention to what policy actually is. And policy right now is very what we would call reflationist, or it's aimed at increasing demand and reducing unemployment. So the policy itself actually is focused very squarely on the employment objective. And Bernanke was very clear in his remarks that inflation, although it's ticked up a little bit, it is due to transitory factors, energy prices, food prices, which he and other members of the Federal Open Market Committee expect to be transitory. That means they won't last indefinitely. And as a matter of fact, in recent days, the spot price of oil came crashing down. All right?
As it did yesterday.
Or
yes.
if you look at some of the other commodity prices, like copper, for example, is down over 12% over the last few weeks. Gold is down, and so forth. So part of what's occurring right now is there was a speculative element in some of these commodity prices. That seems to be being sucked out. And another thing I would just point out is that when prices go up, as they have for oil and then gasoline, people begin to react to that because it's expensive.
Absolutely.
And so we know that in the month of April, demand for gasoline in the U.S. dropped by 5%. And that actually then sets into motion a self-correcting set of forces, which you remove demand, then you put downward pressure on prices, and that's sort of what's going on at this point. So I think Bernanke's comment about this is transitory is on the mark, and then you can look at it in a different way and say, well, If prices are to be sustained at a higher level, what has to happen? Well, the increase in food and gas prices has to filter through into other prices and be sustained.
Right.
And there's no indication that that's the case. In fact, if you look at wages, which we talked about a moment ago, they're stable. And one of the most important things that tells you that inflation is a really significant risk is when wage rates begin to go up, and they're not going up, they're very flat at the moment. So I think we come back and take Chairman Bernanke's words at face value. It is transitory. There's no reason to get overly excited at this particular point in time. Now, having said that, you said, well, when will they tighten?
Right.
All right, when will they tighten? And there's, as usual, you've got as many views on that as you've got people that are willing to offer an opinion. And I'll just give you the range of those views. Those who think the economy will strengthen rapidly say, hey, maybe by the end of 2011, that's this year, you'll get the first tightening. You've got others who say, no, it won't occur until 2013. So you've got about a 5 to 6 quarter spread there between the different views. And I would just point out that if you go back and get a look at views a year ago, you had the same spread, and they've all been pushed out. And so the likelihood is it'll be towards the longer end of that range rather than the shorter end.
Sure.
And here are the reasons. The economy, again, when do you raise rates? Well, only when you believe that inflation truly is going to become a real risk, not just a theoretical one.
Right.
And when does it become a real risk? Well, it becomes a real risk when employment begins to tighten in and wage rates begin to go up. And that seems a long, long ways
Yes, it
away
does.
yet. So I don't think, you asked for my prediction, I would be in the 2013 camp.
Oh, you're in that camp. Okay, it makes sense. Now, you mentioned that, according to the law of economics, demand was lowered for gas when fuel prices rose. Now, when those come back down and, food prices come back down, commodity prices come back down, will demand then rise almost immediately, or will there be a lag?
Well, it'll probably come back reasonably quickly, this particular period of time, because unlike the last time you had the price spike in oil, which was in the summer of 2008, you actually have an improving condition in the overall economy, whereas at that time it was going in the other direction. And so when it was going in the other direction, the demand destruction indeed was sustained, but it was because of loss of jobs and loss of income. So I think, yes, it will come back, not quickly. And if the price increase were to be sustained for a period of time, and we're still not out of the woods on that,
No.
all right, just because there was a break in the spot price of oil in the last few days doesn't mean that will be
Right,
sustained, because we
exactly.
still have things going on in the Middle East.
Absolutely.
Bad things can happen there, and we just don't know. So it's sort of stay tuned, just to watch.
We will. Okay, so as you mentioned in your previous letters and also early on in our chat, the recovery will proceed, but fairly slowly. On April 28th, GDP was released for quarter one, and that was stated that it only grew 1.8%, down from 3.1% in the final quarter of 2010. Now, what are the major drivers of this downward shift in GDP, and when and if, do you think, will it pick up in 2011? And can you also comment on the various forecasts that we've been seeing for future GDP growth?
Certainly. Well, I'll try to answer all those questions one at a time.
I appreciate it.
The first quarter number obviously was disappointing at 1.8%.
Right.
Generally, the belief is that you need to have a GDP growth of about 2.5 to 2.75% just to keep pace with growth in population and productivity. And anything less than that actually is going to result in more slack in the economy and actually upward pressure on unemployment and that sort of thing. So 1.8 was not a good number. But then it's important to look below the surface and look at the components of GDP and see whether the 1.8 is reflective of a real trend or whether it's just some statistical noise. And it looks to me like the first quarter number had a lot of statistical noise in it.
Okay.
For example, the key component of GDP, and GDP, by the way, is expenditures, is consumer spending, and that accounts for about 70% of GDP. That particular measure in the fourth quarter of last year was about a 2.8% growth rate on a quarterly basis, annualized.
Right, so that was not consumer spending, that really was the main driver.
Right. That was from the fourth quarter, but in the first quarter that did contract to 1.9, so it was less.
Okay.
All right, so it was less in first quarter, but if you adjust that for the 70%, that was a 0.6% difference. I'm getting a little technical here on you, but the point here is we had 3.1% growth in the fourth quarter, 1.8 in the first quarter. If you simply took out the change in consumption, it would have been 2.5. Now, 2.5 would have been about what you would need to be on a steady basis. So where did the rest of that come out? Well, it was primarily in government expenditures, and the government expenditures actually subtracted 1.1% out of the first quarter. That might seem bizarre to folks because, well, we have these huge deficits, we're spending all this money.
Right.
Well, the only thing that's counted in GDP is government expenditures for services and goods. All transfer payments are not counted. Those are actually included in other measures like consumer spending. So I wouldn't get too excited. Now let's go on to what does the future hold in store. And the Federal Reserve, when it had its Federal Open Market Committee meeting here recently, actually did slightly decrease their forecasts. But they're still in the 3 to 4% GDP range. And as I look at other forecasters, I find most all of them are in that range as well.
Okay.
Well, that's a lot higher than, say, 1.8%. So
Absolutely.
I think the collective wisdom, and I put myself with the collective wisdom, is that 3% is likely, and it's even possible you might get 4%.
Great.
The difference between the two levels really turns on, one, how strong you think the recovery is going to be in employment and therefore in consumer spending. And two, it also has to do with consumers' behavior on saving. If saving is constant, then what you just have is income flows through into consumer spending, and you watch it, income growth, to tell you what spending growth will be. But if consumers begin to pull back on saving, they can actually increase spending faster than their income growth. Or if they increase their saving, it goes in reverse. And so what I find is if you probe into the details of a number of forecasts, a lot of the difference does depend on their assumption about consumer spending behavior, which in turn has embedded in it assumptions about their debt and savings behaviors.
Sure.
So I think there's a reasonably good chance that we will see 4% for the rest of the year.
Okay.
But let me point out, if we need at least 2.5 to 2 3/4 just to stay even. 4% is not great. It's not going to close that gap down very fast. And so don't assume that a 4% rate of growth is suddenly going to unleash things and the Fed's going to have to act.
We'll remain cautious. Moving on to the sovereign debt crisis in Europe, which I don't believe has been getting very much press lately, but I would like to touch upon it today. Lately, there's been division in Europe as German officials have voiced their support for Greek debt restructuring, while some other entities such as France, the ECB, and the European Commission have argued against it so far, fearing that it would worsen the outlook for other countries such as Ireland and Portugal to repay their debts. Do you think there will be further division amongst these European leaders? What would be the effects of that? And talking a little bit about debt restructuring, what are the consequences of debt restructuring if that were to happen?
Well, again, you've asked a lot of questions. Let's take those one at a time.
Okay.
And if I forget one of them, you'll remind me, right?
I will, absolutely.
Okay. So let's, Europe is still a situation that's actually deteriorating. So you should not take silence or lack of press coverage as an indication that things are getting better. It's quite the opposite. But the world is distracted by other things right now, and news media only can focus on so many things at one time. like Osama bin Laden here recently,
Right.
or what's going on in Libya, and even that's off the front pages now. So the European situation is not on the front pages. It's not being paid much attention to at all. But if you look at some of the details there, they are not encouraging. For example, in Greece, the interest rate now on the 2-year Greek debt is at 25%. And it's denominated in euros. Now, if you want a great yield and you're not worried about euro-dollar currency risk, go buy Greek debt.
Right.
All right, but the 25% yield should tell you something. It's telling you that the market actually does expect sometime in the next 2 years that there's a pretty high probability that that principal will in some way be reduced. Now, it can happen in a couple of different ways. It can happen directly through what's called debt restructuring that you mentioned. And debt restructuring simply would be, you give me your security and I give you back one that's, let's say, 70 cents on the dollar, or 70% of the euro's value, and you do that on a large enough basis. Now, why would that be done? Well, the purpose would be actually reducing the indebtedness of Greece, but also the debt carry burden. Another way that's been suggested is to so-called reschedule the debt. And that's where you have a 1-year piece of paper, and I said, well, I'm not going to pay you back in 1 year, but I'll give you a 10-year one.
So you're extending the maturity date
Extend the
on that.
maturity, but you know, you don't have to take a loss on it. I might even give you a different interest rate, but it's a way of kicking the can down the road and buying time.
Sure.
Now, the reason that none of the, well, that one really basically is just buying time. It doesn't solve the problem, because the problem is in Greece, the size of the debt and the cost of it is simply too large. And what the whole austerity fiscal consolidation program has been all about there is, well, if you get your house in order, you can get the debt down, everything will be hunky-dory. Well, the problem with that is that as you get your house in order, you kill off jobs, you kill off tax revenues, and what's actually happened in the year since the Greek debt situation, the bailout occurred, is their debt's gone up. The burden's gone up and the economy's gone down, and it's not a healthy situation, and it continues to deteriorate. Portugal, more recently, they just, within the last week, reached an agreement with the IMF and the European Central Bank on a bailout for Portugal, and it's pretty significant in size. It does have the benefit of reducing the Portuguese borrowing rate by about half on that amount, so that it will have a real benefit to them. But it will be similar to the Greece situation in this sense, is that they will have to contract the economy, reduce spending, and things of that sort. And it's not clear that it does anything more than buy time there as well.
Right.
Then you have Spain, which is the big one that everybody's watching. Spain's actually very stable right now in the marketplace if you watch the debt spreads. The Spanish GDP is limping along, but positive, which is a good thing, I think, because they already have voluntarily entered into austerity, which is, again, reducing government spending.
As a preemptive measure.
As a preemptive measure.
Sure.
And maybe that will work. Maybe that will work.
Do you think it will?
The odds are not great, because when you have large amounts of debt, to work out of them through reducing expenditures is simply a very painful experience. As in the case of Greece, you do reach some point at which you can't do it. And that's the question, is how close is Portugal? Okay. Part of the reason for the debate in Europe about the different solutions, one has to do with just the paranoia about the contagion effects that are out there, because the banking system in Europe holds a lot of the sovereign debt.
Absolutely. And
the concern is if you uncork the bottle and you let the genie out,
you don't know where it's going to go.
You don't know where it's going to go, and it might lead to a panic.
Absolutely.
With the European banks, similar to what we had in 2008 in the United States. The other problem, which I've discussed in letters and we don't have time to go into in detail here, is over the longer run, there is an issue that if the European Monetary Union is actually to work in the long term, fiscal discipline has to be imposed on the different members. They can't just go their own way and do whatever they want. And there's debate about how to do that, and what gets in the way is sovereignty issues. You know, I'm a country, I should be able to do my own thing, but when you're in a monetary union, doing your own thing can lead to huge problems, and that's exactly where we're at.
Absolutely.
So stay tuned on that. This is kind of a slow-moving train, but it's one that's not moving in the right direction.
No, not unfortunately not. Okay, well, those are all the questions I have
Well,
today.
I have one other thing here I would like to just give an update on,
Absolutely.
and that's the U.S. fiscal situation, which we've talked about in past videos. And where we're at now, we have the budget resolution was passed for 2011, so that's ancient history at this point. And the current focus is on the debt ceiling, which we've talked about before.
Yes.
And the Treasury has announced that on May the 16th, it will formally hit the ceiling. They've also announced that they have all kinds of things they can do to stretch out the actual insolvency date, insolvency in quotes, to August the 2nd. All right?
Which is later than
Which is
June or
later
July, which we've
because
talked about.
what they said, hey, tax collections have been stronger, which actually is a good thing because that would suggest the economy is a little stronger.
Right.
But that's the window. So it's May 16th to August the 2nd. And so don't expect any immediate solution, and because the crisis is not yet imminent. But it's interesting that there's been some shifting. You've got the Paul Ryan program that was put out a few weeks ago. You have President Obama's. There's quite a difference between them.
Yes.
Quite a difference. But Paul Ryan's did not fare well in the Medicare one, and the Republicans suddenly have gone very silent about that. But I would say it's becoming clearer to me that yes, the debt ceiling will be raised, but probably only through the presidential election, so that it will become a major issue immediately following the presidential election. And any significant action on the long-term deficit problems will probably be deferred until after the election. So look at a lot of political jockeying and commentary and discussion with very little substantive outcome.
Right. So in the next few months, will we only see jockeying? Will we see the Republicans
you'll
kind
see
of
some
come
real
out with
results.
something else?
You'll see some real results, but what I'm saying is the dramatic results probably going to get postponed.
Sure, absolutely. Well, thank you for that. And we look forward to hearing about that in future videos, as I'm sure that will come out.
All right.
Well, Bill, thank you so much for joining me here today. It was a pleasure speaking to you, and I look forward to speaking with you next month.
And I as well look forward to speaking with you.
Great.